Digital trade is changing markets, and traders are using technical analysis to read price action and to spot opportunity and to manage risk in real time. This report explains how technical analysis is applied across digital trade assets, including cryptocurrencies, stablecoins, and tokenized services, and it shows which indicators matter now and why traders and institutions are paying attention to price structure, volume, and momentum data instead of only headlines and fundamentals. What we mean by digital trade. Digital trade covers digitally delivered services, digitally ordered goods, and the tokenized exchange of value on distributed networks. This includes streaming and software as a service, cross-border e-commerce payments, and blockchain-based token transfers that underpin many new types of trade flows. Recent institutional studies estimate that a large share of global trade is now digitally ordered or digitally deliverable, which is reshaping export patterns and trade statistics. Why technical analysis matters for digital trade assets. Digital trade assets trade in continuous global markets that react to macro signals, regulatory news, and liquidity flows at all hours. Technical analysis helps traders and commentators translate raw price and volume action into interpretable setups such as trend continuation, trend exhaustion, support and resistance, and breakout momentum. Because many digital trade assets have thin liquidity in certain venues, technical signals can warn of exaggerated moves and help allocate position size to reduce slippage and tail risk. Core indicators traders use now. Relative Strength Index, or RSI. RSI measures recent price momentum and flags overbought and oversold conditions on a scale from 0 to 100. Values above 70 often signal overbought conditions, while values below 30 indicate oversold conditions. Traders watch RSI divergences where price makes a new high or low, but RSI does not, which can presage a reversal. Moving averages and moving average convergence divergence, or MACD. Moving averages smooth price data and provide dynamic support and resistance levels across timeframes. MACD compares two moving averages to expose shifts in momentum, and crossovers often inform entry or exit decisions. Large market players watch weekly moving averages for regime changes, while short-term traders focus on the 5 and 21-day averages.
Volume and on-balance volume.
Volume confirms price moves, and on-balance volume aggregates volume with direction to show whether money flows support a rally or decline. In digital trade markets, sudden spikes in volume with price action validate breakouts, while low-volume breakouts are suspected to fail. Volatility structure and ATR. Average true range measures volatility and helps size stop losses and position allocations. When ATR expands, traders expect larger swings and adjust targets and stops accordingly. Chart patterns, trend lines, and price structure. Classic patterns such as head and shoulders, double tops, and cup and handle appear on token charts and on institutional proxies for digital trade. Pattern context across timeframes matters because a daily pattern validated by weekly support has higher conviction than a 1-hour pattern on low volume. How indicators perform differently in digital trade markets. Technical indicators were developed originally for equities and commodities, yet their statistical behavior can differ in tokenized markets. Empirical studies suggest that some indicators such as RSI retain predictive value, while others may be less reliable depending on market microstructure and exchange fragmentation. The practical takeaway is to combine indicators and to validate signals with volume and cross-exchange liquidity checks. Institutional narratives and their effect on price action. Digital trade markets are sensitive to macro narratives such as regulatory clarity, adoption of stablecoins, and shocks to payment rails. When major banks or regulators signal acceptance or restriction, price action often accelerates, and technical indicators will show strong trending behavior or violent mean reversion, depending on the nature of the news. For example, a bank forecast or a change in stablecoin regulation can trigger a re-rating of on-chain transaction demand, and this shows up first in price and volume patterns on spot markets. Case study: Bitcoin and Ethereum. Technical outlook. Bitcoin and Ethereum are proxy risk assets for many digital trade narratives. Recent technical reads from major charting services show mixed momentum, with oscillators often in neutral territory, while moving averages offer clear levels to watch. Traders cite classic support and resistance zones with RSI readings that warn of short-term exhaustion or cooling-off periods. Chart consolidations followed by high-volume breakouts suggest continuation setups, while failure with rising volume can convert support into resistance quickly. Risk management using technical analysis. Technical analysis is not a prediction machine. A disciplined approach uses stop placement, position sizing, and scenario planning. Technical stops placed below structural support or above structural resistance are preferred to arbitrary percentage stops. Risk managers monitor correlation across major tokens and across spot and derivative venues to avoid simultaneous liquidation pressure in multiple markets. Common pitfalls and how to avoid them. One indicator alone is rarely decisive. Overfitting to historical patterns leads to false confidence. Ignoring order book depth and cross-exchange slippage can produce losses when a signal becomes crowded. Reviewing market microstructure and adding execution rules reduces surprises. Trading strategies that fit digital trade assets. Swing trading using moving averages and momentum filters. Mean reversion in less volatile tokens using RSI bands. Breakout trading using volume confirmation and ATR-based position sizing. Trend following on high market cap liquid tokens using weekly moving averages and trend confirmation across multiple time frames. How AI and data changes technical analysis. Machine learning models can process hundreds of indicators and identify nonlinear relationships that human traders miss. However, these models depend on data quality and can degrade when market structure shifts. Human oversight remains crucial because data-driven models may latch onto spurious relationships that break under stress. WTO and other policy bodies warn that AI-driven trade gains can widen gaps between economies without fair access to infrastructure and data resources. The role of research and macro trade reports. Official trade statistics and reports help place price action in context. When digital trade volumes grow across regions, this influences long-term demand for infrastructure and for tokens used as settlement mediums. Reports from international organizations show increasing shares of trade that are digitally ordered or digitally deliverable, and these shifts matter for how markets price long-term adoption. Practical agenda for YouTube viewers who trade or follow digital trade. Watch major support and resistance levels on daily and weekly charts. Always confirm breakouts with volume and cross-exchange liquidity. Use ATR for stop placement and do not increase position size after a runaway move unless liquidity supports it. Check macro narratives that can change regime quickly, such as regulation or major institutional adoption. How journalists and content creators should cover technical analysis responsibly. Explain setups and the reasons behind a technical read. Avoid telling viewers that a trade is guaranteed. Show alternative scenarios and point out the key levels that invalidate the thesis. Use visual charts and annotate volume and indicator readings for viewers to follow along. Conclusion, summary, and forward view. Technical analysis is a live language that turns raw price and volume data into actionable signals for traders and for analysts covering digital trade. The best practice pairs indicator signals with volume structure, order book information, and macro research. As digital trade continues to grow and as tokenized instruments mature, technical analysis will remain an essential tool for reading market psychology and for managing risk. Please like, comment, and share the video and subscribe the channel for watching more videos.